Good morning, everybody. Hi, Alan. Hi, Veronica.
Good evening.
We're going to talk about the markets today. Obviously, there's been, a lot of bullish action in the market this week, so I'm going to go over that. But Ron, with bullish action in the stocks, what does that mean for bonds and inflation? I think you want to talk about how that's headed.
Mm-hmm. This week, we presented our AVC strategies that we've been using for years, and those AVC strategies focus mostly on the stock market. And right now, the investors have to restructure how they think about asset allocation, especially about fixed income. And that's why in our strategies, we do not focus on bonds and fixed income. And some of the most successful fixed income managers are recommending that investors own more stocks, like highly quality dividend stocks, as well as alternatives to generate income. That's why in our strategies, we have like blue chip strategy that includes not only the growth, but also the income, and it gives the safety for investors. But if we talk about fixed income, we're trying to get away from fixed income because now investors in fixed income need a new approach, and definitely to reset their expectations. Because fixed income used to be where you find safety and income, but now you have to choose either find income or find safety. And finding income in bonds nowadays has gone from extremely difficult to almost impossible. And finding safety is also really difficult. And according to Morningstar, core bond strategies lost about 3% on average between mid-February and mid-March, just in 1 month. And for bonds, that's of course quite risky. And that's happening because we all know the huge drastic changes in fixed income markets. The Federal Reserve will keep interest rates near zero for another 2 years, plus central banks' aggressive bond buying. So there is not even much to purchase lately. So bonds in the future, in the near future, are likely to return 1 to 3% before inflation. And that's about half of the returns even a couple years ago. Worse than that, it's not even the income that they're getting more riskier. Just achieving those returns will require taking more risks. So what else for investors who are rethinking asset allocation but still want to have bonds in their portfolio? We would look at those ETFs that have that focus on kind of shorter bonds, and also looking for a little bit riskier bonds, and are also going to corporate bonds. But in general, I want to stress that if you're looking for income, most managers are recommending going to high quality stocks.
Mm-hmm. Mm-hmm. That's because interest rates are so low. Are they expected to go lower though? I mean, this is what this is. This chart you show, right? This is the historically low levels, and the Fed will keep the lid on rates.
Yeah, they will keep it at least for next 2 years, this low interest rates or near to zero interest rates. So there is no income in bond markets.
And a reminder that in some European banks, you've got negative interest rates on euro deposits.
Yeah.
So I mean, there's just no likelihood.
There's no incentive. There's no incentive at all. There's an incentive to borrow and spend your money, and it's not stimulating the economy.
Or invest your money into more aggressive assets, which is just what Veronica said.
So where the investors should go if they want to still invest in bond, and according to Barron's, you can see the bond list on the screen, the bond ETF list with the yields and potential growth they have. But as I said, most importantly, most money managers recommend just sticking to stock market if you wanna find income.
Yeah, and what's interesting, Ron, what you were sharing with us is that if you look at what's hot in the fixed income market right now, it's not actually bond funds, it's convertible bonds, it's international corporate bonds, it's actually preferred stock, and it's long-term corporate debt in the United States. So it's stuff where there's actually some more upside than just.
It's kind of marginal.
Yeah. So if you look at if you look at what the whole fixed income kind of space includes, right? These are what's hot right now, and that's kind of making a point is you can get a 2.5 or 3% yield in these types of things versus what I think Ron showed in our last slide was closer to 1 or even less than 1 in certain bond cases.
There's no real value. It goes back to what an old friend of ABC's, a fund manager, basically said. Who runs a cautious fund, and he's underweight bonds and he's heavy cash because his answer is, I'd rather be in cash with no downside risk. I'll lose out 1% upside, but I'll be ready to go into other assets as buying opportunities present, rather than having money in bonds with a huge downside risk that if there is an interest rate rise, which might happen, but it's unlikely, but it might happen, these things are going to get killed. I mean,
and Ron was saying there's the default rates or the hindrance that can come up with owning bonds because of their liquidity issues
especially on the uncertainty due to coronavirus.
Right.
We don't know. I mean, every day you're seeing stories in the media about shops closing down, branches closing, whatever it is, but job losses all over the place. I mean, these are going to translate sooner or later into companies going bankrupt. We covered this a couple of months ago in the middle of the summer, I think, about how many global bankruptcies of more than
we talked about the zombies. Remember the zombie companies and all that stuff. Yeah, so this is all.
I mean, this is a lot of corporate bond risk, I think.
Okay, so let me take a look at real quick some of the stuff that's happened this week in terms of the markets, because the markets have been going up. So there's been a change in the talk. There's been a change in the discussion towards a Biden win. And the Biden win means a bigger spending bill, even though Trump here, you can see on Wednesday or Tuesday afternoon, Trump right before the end of the market here said, I'm not going to deal with Nancy Pelosi and we're calling off all negotiations. Well, that was just maybe one of his deal tactics, like trying to negotiate a better deal or whatever. But the idea here is that if there's going to be a Biden win, or if Trump's hand is forced and there's going to be some kind of a stimulus package, everybody's waiting for that, and the markets are responding positively in expectation of that. So you had the building materials go up 5% this week. We had a broad-based rally. You can see that if you look at the Russell 2000, where the Russell 2000 was up.
This is much more interesting because this is what we were looking for in the past, a broad-based market rally, much more than just the FANG stocks, basically. Right.
It's so there was there's a 6% currently increase in IWM since Monday morning. That's a good.
Is that do you think that's likely to continue? Is that the big question? Is this?
Yeah, I think that is likely to continue. Broad-based rallies coming out of a weak September and October, or early October. It was really late September when the whole market switched over. So we're already a week in. It seems like these are potentially the bullish shift is happening a little early this year. And that puts seasonality strategies are under a little bit of an early takeoff here. Now, what that means is a lot of this can fall out in the second half of October, and we need to see what happens in the later on. But right now, it's boding well. And if there is a pullback in October, at the end of October, it shouldn't be too bad, and we should be able to see a rally then to the end of the year. And I think that's really what we're starting.
I mean, that's exactly what I've been getting in talks with clients this week, and in talks between us as well, Chris. That basically we're preparing our clients' portfolios for seasonality, but really for the next stage of what we hope is a bull market. there has been a bit of a pullback in September. I don't know if you can pull up a September NASDAQ or something like that while we're talking. But
yeah, it's 4 negative weeks. I mean, it was pretty obvious.
Yeah,
We had
I mean,
this,
so
yeah.
that's the pullback that kind of we were expecting, that scary September that we called it. And yeah, maybe it is happening a little bit early. I'm not sure I want to jump in. I'd rather be in late to the market than a little bit early, although, you know, there's some pretty big moves, especially in the IWM that you showed earlier, that have happened. I mean, there was basically one of the articles that we discussed earlier was, if I go to this was the Goldman Sachs article that actually came out, where the chief economist basically says that a Biden blue wave would prompt an upgrade in growth forecasts, essentially because of infrastructure spending. So basically, the blue wave would still have mixed implications for U.S. stocks. Biden's advocating a 7% percentage point increase in the corporate income tax rate from 21 to 28%. But on the positive side, investors should expect a blue wave. From blue wave, the following: easier U.S. fiscal policy, reduced risk of renewed trade escalation, and a firmer global growth outlook, which that's all positive for stocks. What it is negative for the dollar. Yeah, the dollar got hit pretty bad, which we've seen in a rebound in gold and other mining stocks and other.
Well, we really saw it in IWM. If we go back and look at this chart again,
right, okay.
So we had a sell-off here around 10% in September. That's a good market sell-off. I think, and we talked about specifically the number 10% in the FANG and the market in earlier in August and stuff. And we said, look, it'll probably pull back. It won't be extreme like in March, but it will be a pullback. And then we've had a huge rise now, 13% up since that low, and it's been up 6% this week. So that's the Russell 2000. That's the small cap index. That's the kind of broad-based rally we're looking for. But it's also happened in places where we were, talking about earlier too, is XLI, where you saw since the beginning of October here, a good 6% increase in industrial stocks. And transports is quite interesting, because in transports you see it making an all new high here. Transports are kind of the leaders of the market, some people say, and this has already come back to its previous
Chris,
highs and already making new highs.
Transports include airlines.
If you look at what the ETF owns, it owns things like FedEx and United Postal Service, which are transports in the way that they're about the economy coming back, right?
It's also about online deliveries.
Right, online deliveries in COVID. So if logistics. You look at FedEx chart and rail. And rail is right. Basically delivering goods not directly to the consumer, but to the warehouses. So if you look at what's in here, it's not about airlines so much as we think it is. It's about transport of goods. So this is what this is all about, and that's why this is up. If you look at some of those specific names, you're going to see FedEx is really run. It's like a giant growth stock. I mean, it went from 125 at in the beginning of June to 270 right now. So, you look at even some of these rail companies like Norfolk Southern, and it's back above its highs. This is what happens when people think the economy is going to open up, or even if it doesn't open up, people still need goods, and that's going to be delivered by rail and freight services.
Yeah, I was just going to say, going on from that, we've got the seasonality aspect, which is, so it's not only what is happening with, because we've got U.S. politics, obviously that's having a big effect on, just so happens that the season, when the seasonality kind of kicks in, the positive months kick in, which is kind of autumn, of the autumn part of the year, that's when the U.S. election happens to be. But if you look at, for example, I'm just going to try and bring up a graph with historical seasonality, which I think is interesting, and basically where it plots the summer months where basically the market doesn't go anywhere. But this is the average daily pass for the S&P 500 since 1928. So you can see that it tends to rise over the year, but it kind of takes a breather in the middle of the year, and that's the weak part of the seasonality. And then, as Chris said, it's a little bit early to kick in. It was late September, early October this year. Maybe it's a false dawn for the moment. Who knows? But I mean, that's when around the end of October is usually when we would start to see the seasonality bull growth mechanisms kick in, and that's when people should be getting back invested. So that's what we're talking to clients about this week, and that's what I guess we'll be talking about next week too.
So I wanted to show this simple chart that we talked about when we talked about strategies this week with Veronica. We had a Russian webinar in Russian. So we talk about what happens if you follow a seasonality approach and you switch from aggressive funds or more aggressive funds into less aggressive funds in the summer. And you can actually beat the S&P quite nicely. You know, over the last 10 years, you're beating it by 25%. And that's quite a big difference. If you just follow some basic seasonality strategies, and it was nice to have clients online asking about that and talking about that with them this Wednesday. So we'll probably talk more about that, how that works, and it's been on our blog. And I think that's all for today, guys, and we'll see you next.
Yeah, we'll look forward to seeing you next Friday.
All right. Thank you. Bye-bye.